This wasn't a rally. It was a system failure. On January 26, 2026, silver didn't climb. It detonated. In a matter of hours, the price shot straight up to around $117 an ounce, then collapsed almost $10 just as fast. That's the contradiction. The strongest single-day surge since 1985 ended looking like a crash. And if you think that's just trader drama, here's why it matters to you. Moves like this don't stay trapped on price charts. They leak into currency confidence, savings, and how stable money actually is when pressure hits. Fact, silver jumped roughly $13 to $15 intraday, more than 10% at the peak, after trading calmly near 108 overnight. Fact, momentum indicators hit extreme levels with a 4-hour RSI near 87. Inference, this wasn't healthy acceleration. It was stress building faster than the system could absorb it. But here's the part nobody's saying out loud. This move wasn't the story, it was the signal, and the way it reversed tells us exactly what kind of market we're really in now. At first glance, the event looks simple. Silver surged, hit a high near 117, then pulled back hard. Most coverage stops right there. But that framing misses what actually matters. This wasn't an isolated spike. It fit a pattern that's been building for months. Fact, silver had already logged 9 consecutive months of gains before this day. Fact, prices held steady overnight around the 108 to 111 range, then exploded higher on heavy volume before reversing. Inference, this wasn't random enthusiasm. It was pressure that had been compressing, then released all at once. Now zoom out. Vertical moves like this don't happen in calm systems. They show up when normal price discovery breaks down and liquidity starts behaving unpredictably. Notice how fast the move erased its own gains. That speed tells you the market wasn't agreeing on value. It was arguing in real time. Here's the question that reframes everything. If this were just excitement, why did it require such violence to resolve? And if this is part of a larger cycle, what does that say about where the pressure goes next? Here's the claim that makes this uncomfortable. That reversal wasn't weakness. It was exhaustion colliding with leverage. Fact, as silver pushed higher, momentum readings went into extreme territory with short-term RSI levels reaching the high 80s. That almost never happens in a stable trend. Fact, volume surged on the way up, then surged again on the way down. Inference, this wasn't one side winning. It was two forces slamming into each other at full speed. When price goes vertical, support structures disappear. There are no orderly pullbacks, no levels built by consensus. So when selling starts, it doesn't step in gradually, it cascades. That's why silver didn't drift down from 117. It dropped fast straight back toward the 108 range. But notice what's missing here. There was no slow fade beforehand, no distribution phase, no calm topping process. The market didn't have time to cool. It overheated, then snapped. This is where the story flips. Because when moves end like this, it usually means the system needs a reset, not a reversal. And the way markets reset under leverage pressure changes what comes next. After that snap, the situation didn't calm down. It intensified in a quieter, more dangerous way. Because extreme moves like this don't just shake out traders, they normalize behavior that shouldn't be normal. Fact, the rise into the 117 to 120 range happened so fast that traditional trend lines were effectively erased. Fact, analysts had to switch to long-term logarithmic charts just to find meaningful resistance, connecting highs from decades ago. Inference. When markets are forced to reach that far back for reference points, it means the present structure can't explain itself anymore. This kind of vertical action has a precedent. Not academically, not in textbooks, but in moments when markets outrun their own plumbing. Think of episodes where price didn't respect gravity until it suddenly did. Each time, the move itself rewired expectations. What once felt extreme starts to feel normal. Notice what's happening here. A $10 intraday swing is being discussed as a routine correction, not a shock. That's escalation. That's a market adjusting its pain tolerance upward. And here's why that matters. When volatility becomes normalized, the next move doesn't need new information. It just needs another imbalance. And those are already lining up. Now, the evidence gets harder to ignore. Fact, the 117 to 120 zone isn't just a random number. It lines up with long-term resistance stretching back through prior cycle highs adjusted for monetary expansion. Fact, silver had already risen for 9 straight months before hitting that level, a statistical outlier that almost never extends indefinitely. Inference, by the time price reached this zone, the market was no longer discovering value. It was testing limits. Here's the contradiction that changes how you see it. Public commentary stayed bullish, even euphoric, while price behavior screamed strain. Words said more upside, price said too fast. That gap matters. At the same time, leveraged vehicles amplified everything. Paper exposure allowed traders to chase momentum with borrowed conviction. When prices surged, gains multiplied. When selling started, exits narrowed instantly. That's not opinion. That's how leverage behaves under stress. Notice what wasn't happening. Physical holders weren't dumping metal by the truckload during intraday swings. This was paper turning on itself. Futures, ETFs, margin positions, fast in, fast out. Here's why that detail changes everything. If the violence is coming from leverage, not liquidation, then the underlying pressure hasn't been released. It's been postponed. And postponed pressure doesn't disappear. It shifts. Then the pressure stacks quickly. Fact. Margin requirements were raised, increasing the cost of holding leverage positions. Fact. Short sellers remained active even as prices pushed higher, some sitting on deep unrealized losses. Fact. Institutional forecasts began diverging sharply, with some calling the rally unsustainable even as volatility expanded. Inference. This wasn't one narrative taking control. It was multiple narratives colliding at once. When leverage gets squeezed from both sides, things accelerate. Long positions are forced to trim. Shorts are forced to defend. Liquidity thins, not gradually, but suddenly. That's how a market loses its sense of direction. Add another layer. Price discovery here wasn't being driven by physical supply changing hands. It was being driven by positioning, margins, and forced decisions. That's why moves felt disconnected from fundamentals hour to hour. Now watch how fast this stacks into something bigger. A vertical run, a violent pullback, tighter margins, conflicting forecasts. Each one alone is manageable. Together, they compress time. And compressed time is when markets stop reacting and start lurching. So pause here and ask the only question that matters now. What happens if this continues? Now shift the lens away from charts toward you, because this doesn't stay abstract for long. When silver moves like this, it's not just traders feeling it. It bleeds outward. Fact. Prices swung nearly $10 in hours. Inference, that kind of instability forces repricing everywhere downstream, from hedging costs to inventory decisions. If you hold savings, this matters. If you earn in dollars, this matters. When a metal that size can't find equilibrium, it signals that the measuring stick itself is wobbling, and that affects ordinary decisions. When to buy, when to wait, what feels safe. Notice how quickly expectations shift. A drop toward 100 is talked about as normal, even healthy. That tells you volatility has already been absorbed psychologically. And once people adapt to that speed, shocks feel smaller than they are. This is how instability becomes livable. Not by resolving, but by becoming familiar. And familiarity is dangerous because it lowers defenses. If this feels familiar, say so in the comments. Not because it's dramatic, but because markets repeat patterns through people, not numbers. And once enough people feel it at the same time, the system starts responding to behavior, not logic. Here's where the story gets quieter and more unsettling. This isn't about silver. It's about how systems behave when incentives bend. Fact. The global monetary base has expanded dramatically, while the physical silver market remains tiny by comparison. Inference. When large pools of liquidity move toward a small outlet, price doesn't adjust smoothly. It jumps. Think of it as pressure moving down a funnel. At the top, you have enormous volumes of financial claims, debt, and derivatives. At the bottom, you have a limited amount of tangible assets. When confidence shifts, even slightly, the flow overwhelms the base. This is why moves look irrational in real time. The system isn't broken. It's doing exactly what its structure forces it to do. Leverage amplifies the move. Fear accelerates it. And spectacle keeps attention locked while the mechanics grind underneath. Here's the insight most coverage misses. Volatility isn't the problem being solved. It's the signal that the system has run out of buffers. When buffers vanish, repricing happens in bursts, not trends. That's why this feels smarter than outrage. It's not chaos, it's consequence. And once consequences start expressing themselves through price, they rarely stop politely. From here, the path splits, and neither side is calm. One path is stabilization. Fact, after violent breakouts, markets often retest prior levels, turning old resistance into new support. Inference, a pullback toward the 100 range could cool momentum, reset leverage, and buy time. In that scenario, volatility compresses, narratives quiet down, and the system pretends it handled the shock. But there's a second path, acceleration. Fact, the forces driving this move haven't disappeared. They've only been partially relieved. Inference, if price regains the 117 to 120 zone and holds it, the market enters a different regime entirely, one where consolidation happens at higher levels, not lower ones. Notice the uncertainty baked into both outcomes. Neither requires new headlines. Neither needs a surprise event. They depend on follow-through, on whether pressure leaks out slowly or snaps again. This is why the next move matters more than the last one, because markets don't announce regime changes. They drift into them, then lock the door behind you. And right now, the door is still moving. Here's the insight that ties it together. What you just watched wasn't silver misbehaving. It was a system revealing its limits. When price goes vertical, reverses violently, and still holds far above where it started, that's not failure. That's repricing under stress. The move to 117 and the snapback from it wasn't a verdict. It was a message that the old ranges no longer absorb pressure, that corrections don't restore comfort. They just reset the countdown. If you're looking for certainty, you won't find it in predictions. You find it in structure. And the structure here says, volatility isn't going away. It's becoming the language of adjustment. That's the loop to hold on to. Because this isn't the last time a market exposes how thin the buffers really are. It's the first time many people noticed. If you want to understand what breaks next and why it won't look the way you expect, follow along. This story isn't over. It's just entered the phase where moves stop asking permission.